Good morning, students. We're moving on to chapter 14, which is about the cash flow statement. And so the cash flow statement is the fourth financial statement. Remember, we talked about balance sheet, statement of changes in retained earnings, income statement. The fourth financial statement is the cash flow statement. And remember, the fifth thing that's included in a complete set of financial statements is the notes to the financial statements. It may be useful. I asked you to save those financial statements that we did, the first week of school. It may be useful for you to go back in and look at the cash flow statement from those financials that you downloaded on that company. When we're talking about a cash flow statement, there's two ways that we can prepare a cash flow statement. One is what's called the direct method. And the direct method, we actually look at the cash flow that happens, the cash flow inflows and cash outflows that happen, and we say, okay, here's all the cash flows, for example, from sales. Here's all the cash we've expended on insurance, and here's all the cash we've spent on inventory, for example. The other way to do it, which is the way we'll do it in this class, is the indirect method. What the indirect method is we start with net income and then make adjustments to that income by looking at, for example, the change in accounts receivable. So if my accounts receivable goes up, the cash from my sales actually goes down because I didn't receive cash for some of the sales that I made. And so when we do the indirect method, we're actually looking at starting with net income, making adjustments for non-cash items. The primary non-cash item is depreciation. And then also making adjustments for changes in balances that reflect either cash that we receive or didn't receive, or cash that we paid or didn't pay. For example, if accounts payable goes up, that's actually cash that I did not expend. That's cash I did not spend. So anyway, so that's what we're talking about. So on the cash flow statement, there are three sections. The operations section, so cash flow from operations, which would be engaging in the business activity. That's my primary business activity. The next section would be investing activities, which would be purchases of equipment, for example, or sales of equipment would be a cash inflow from an investing activity. And finally, financing activities, selling of stock, borrowing money, repaying loans would all be financing activities. Okay, so with that little bit of an overview, let's look at these two problems that I assigned you for today. Okay, so the first one is purchased equipment for $130,000. That would be an investing activity. Issued $14 of preferred stock for cash. That would be a financing activity. Cash received from sales to customers. That would be an operating activity. Cash paid to vendors would also be an operating activity. Sold building for $19,000 gain for cash. Again, that would be an investing activity. Purchased treasury stock for $28,000. That would be a financing activity. retired a note payable with 1,250 shares of the company's common stock. That would not go on the cash flow statement body itself. It would go as a footnote on the cash flow statement, because that would be just a non-cash exchange. And so when we have non-cash exchanges, then, for example, I purchase equipment and pay for that with a loan, that would also be a non-cash exchange, and that would go as a footnote and not actually on the cash flow statement. Okay, the other problem for today is problem 17, and to go through the journal entries and figure out what effect this has on my cash flow statement using the indirect method. So I issue common stock. That would be a financing activity. I repurchase that same common stock. That would also be a financing activity. Sales revenue would be an operating activity. Purchase of land for cash would be an investing activity. This depreciation expense is a non-cash expense. So using the indirect method, I would add that back into operating because it's a non-cash expense. So it reduces my net income, but there's actually no cash associated with it. Paying of dividends is a financing activity. Land for notes payable means that we do a footnote because it's a non-cash transaction. Because this involves equipment, this investing activity, it looks like we sold some equipment, so that's an investing activity. Bonds payable, repaying bonds payable, that would be a financing activity. A building for a note payable, again, is a non-cash transaction, which would require us to do a footnote at the bottom. This loss on disposal of equipment, we need to make an adjustment for that because the loss, gain or loss, doesn't have anything to do with my cash flow. So I'm going to increase my cash flow because I'm going to increase. It's going to be an increase because that has no effect on my net income. It reduces my net income, but has no effect on my cash flow. All right. That is problem 16 and 17. That's your homework for today. So that's your homework today. What I'm going to do for the next two problems, 28 and 30, is I'm actually going to prepare those cash flow statements, and I'll email those to you sometime on Thursday or Friday. All right, be safe. Make sure you get your homework in. I'm not getting very much homework in, so you need to get your homework in to me. So, but be safe. Bye.